Hey, what's up, stock compounders? Brad here. So today I want to share my highlights from Chapter 20 of The Intelligent Investor. Chapter 20 is margin of safety as the central concept of investment. Now, if Benjamin Graham, who wrote this book, were asked to distill the secret of sound investment into just 3 words, he would say margin of safety. Okay, so what is margin of safety? The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. If the margin is a large one, then it is enough to assume that future earnings will not fall far below those of the past in order for an investor to feel sufficiently protected against the vicissitudes of time. Okay, that's an incredibly important statement for value investors. In the ordinary common stock bought for investment under normal conditions, the margin of safety lies in an expected earnings power considerably above the going rate for bonds. And in the footnotes, today earning power is often called earnings yield. And of course, we've explored earnings yield from Joel Greenblatt in his magic formula. I actually made a video within the last couple of weeks about how to calculate earnings yield for a company. So here it really says, we want an expected earnings yield to be considerably higher than the going rate for bonds. That's going to give us that margin of safety. The danger to investors lies in concentrating their purchases in the upper levels of the market, or in buying non-representative common stocks that carry more than average risk of diminished earning power. Okay, so those earning yields are going to be going down over time. Companies that don't have moats, companies that don't have that strong competitive advantage. You're not going to get the margin of safety with those kinds of companies typically. The risk of paying too high a price for good quality stocks, while a real one, is not the chief hazard confronting the average buyer of securities. Okay? Observation over many years has taught us that the chief losses to investors come from the purchase of low quality securities at times of favorable business conditions. So, because the economy is booming, it can be hard to spot that these are actually low quality companies, low quality securities. Coverage of interest charges and preferred dividends must be tested over a number of years, including preferably a period of subnormal business. So, a recession or a depression. The philosophy of investment in growth stocks, so we're jumping into the area of growth stocks versus what people typically think of as value stocks. The philosophy of investment in growth stocks parallels in part and in part contravenes the margin of safety principle. The growth stock buyer relies on an expected earning power that is greater than the average shown in the past. So obviously with growth stocks, most of the action is yet to come, which can make it harder to analyze. The growth stock approach may supply as dependable a margin of safety as is found in the ordinary investment, provided the calculation of the future is conservatively made, and provided it shows a satisfactory margin in relation to the price paid. The danger in a growth stock program lies precisely here. For such favored issues, the market has a tendency to set prices that will not be adequately protected by a conservative projection of future earnings. So essentially what it's saying here is that typically growth stocks are overpriced. There's actually a lot of optimism built into future projections, which means it's often difficult to buy at a price that's going to give us a margin of safety, at a price that's significantly below kind of a reasonable estimate of intrinsic value. A special degree of foresight and judgment will be needed with these growth stocks in order that wise individual selections may overcome the hazards inherent in the customary market level of such issues as a whole. So really it's just saying usually these are overpriced, so an investor needs a special degree of foresight and judgment in order to identify growth stocks that aren't overpriced. Right, and it talks here about bargain securities as opposed to growth stocks. We're talking about discounted stocks. The buyer of bargain issues places particular emphasis on the ability of the investment to withstand adverse developments. Okay, that's the key when you're buying bargain securities. To maintain a margin of safety, you need to make sure that company can withstand tough times. Okay, really looking at how they've done in past recessions or depressions. If these bargain securities are bought on a bargain basis, even a moderate decline in the earning power need not prevent the investment from showing satisfactory results. So really what it's saying is, if you're buying these bargain securities and you're analyzing them well, even if the earnings yield decreases over time, if you bought with a big enough margin of safety, you can still do well. Let's talk about diversification. There's a close logical connection between the concept of a safety margin and the principle of diversification. Even with a margin in the investor's favor, an individual security may work out badly, for the margin guarantees only that he has a better chance for profit than for loss. Not that loss is impossible. Okay? It's critical, that point there. But as the number of such commitments is increased, the more certain it becomes that the aggregate of the profits will exceed the aggregate of the losses. So if you have bets where you know that your upside probability is greater than your downside probability, you want to make as many bets as possible because it's going to improve your odds of success. Now, where Buffett and Munger deviated and other value investors deviated from this principle is if you're able to identify opportunities where you have a very skewed asymmetrical upside to downside ratio, say you're able to come up with 5 or 10 opportunities where the upside to downside is very favorable. If you add more securities to that portfolio where the upside is just slightly more probable than the downside, then you're going to reduce the effect of those really good investment prospects on your portfolio. You're going to water down your really good ideas. And so that's kind of where Buffett deviated a bit from this theory of diversification. Because, Graham recommends 20 or more stocks in order to be diversified. But Munger or Buffett would say, Munger says 3 is probably enough for the skilled investor. So there's a little bit of divergence there. A criterion of investment versus speculation. So what is investment? What is speculation? Since there is no single definition of investment in general acceptance, authorities have the right to define it pretty much as they please. Many of them deny that there is any useful or dependable difference between the concepts of investment and of speculation. We think this skepticism is unnecessary and harmful. It is injurious because it lends encouragement to the innate leaning of many people toward the excitement and hazards of stock market speculation. So one more sentence. We suggest that the margin of safety concept may be used to advantage as the touchstone to distinguish an investment operation from a speculative one. So the idea here is that, if people don't know the difference between investing and speculation, it's very easy to get pulled into these investment ideas where, there's story stocks, right? They have this potential to change the world and go up 100, 1,000, or even more times, right? But what people forget to do is really weigh the probabilities of success versus the probabilities of downside, of losing money. It's often said intelligent investing, wise investing, is not exciting. It's like watching paint dry, okay? So it's there's this innate leaning of people towards excitement, right? Chasing the stock that could be the next big thing. And this is why Graham here is pushing for a proper definition of investment versus speculation. We greatly doubt whether the man who stakes money on his view that the market is heading up or down can ever be said to be protected by a margin of safety in any useful sense of the phrase. So Graham here is basically saying, don't try to predict what's going to happen next in the stock market, all right? Don't try to time the market. That's a fool's errand. Thus, this is to kind of conclude the investment versus speculation section. We say that to have a true investment, there must be present a true margin of safety. And a true margin of safety is one that can be demonstrated by figures, by persuasive reasoning, and by reference to a body of actual experience. And then just one more thing I want to add. He talks about conventional versus unconventional investments. Often there's areas of the market that people see as particularly risky or speculative. And Graham speaks to that here. It is our argument that a sufficiently low price can turn a security of mediocre quality into a sound investment opportunity, provided that the buyer is informed and experienced and that he practices adequate diversification. For if the price is low enough to create a substantial margin of safety, the security thereby meets our criterion of investment. Okay? So, even in the area of junk bonds, right? And he actually provides an example of bonds and how, in the 1920s, these bonds, there was such a small margin of safety that they were highly speculative. But then when the crash happened, you could buy these bonds for 10 cents on the dollar. And of course, the investment advisors are saying, stay far away from that. It's very dangerous. But what Graham is saying, because you can buy it for 10 cents on the dollar, it's actually no longer speculative. It was speculative when it was fully priced, when it was, at par. But when it's 10 cents on the dollar, now it's no longer speculative. So it's funny how Graham kind of sees risk in these investments in the opposite way that a lot of investment advisors typically see risk. So, and that kind of plays into this whole contrarian viewpoint of value investors. So I think I will leave it at that, guys. I can't recommend this book highly enough, particularly chapter 8, which is all about Mr. Market, understanding investor psychology and how market prices differ from the actual value of businesses. And then what I just covered, chapter 20, which is margin of safety. So incredible. I mean, Buffett calls it by far the best book on investing ever written. Buffett, in my opinion, is the best investor, at least in our age. All right, guys, I'll leave it at that, and I will see you in the next video. Take care.